Here they say in this classwork, they say the following balances appeared in the trial balance of sole traders on the 28th of February 2023. They gave us the cost price of vehicles, gave us the cost price of equipment. They said sole traders bought these assets by EFT on the 1st of March 2022. Depreciation is written off as follows. And they said it's 25% per annum on vehicles, 10% per annum on equipment. And they said the business uses fixed installment method, which is a straight line for both vehicles and equipment. So you just calculate depreciation on cost price. Okay, let's see how we can calculate those. We will first start with our financial year. Financial year will start on the 1st of March, 20.8, and it will end on the 28th of February, 20.9. Okay, there's something here. Actually, it's not even 20.8, it is 20.2 and 20.3. So we're gonna have our financial year as such. I will first start by calculating carrying value at the beginning of the year. Please note that for vehicles, we didn't have any accumulated depreciation because it was bought at the beginning of the financial year. So accumulated depreciation will be zero and carrying value will be the same as the cost price. We used it for 12 months, so we will depreciate it over 12 months by taking the cost price of 120,000 and multiply it by the depreciation rate of 25% and multiply it by 12 over 12. Our depreciation will be 105,000. Ensure that your current year depreciation never exceeds carrying value at the beginning of the financial year. On equipment is the same scenario. We don't have accumulated depreciation because it is new, so the carrying value will be the same as the cost price. And when you calculate depreciation, you'll just take the cost price, you multiply it by the depreciation rate of 10%, and that will give you 31,000. So what is our total depreciation for the current year? Our total depreciation for the current year will be the sum of the depreciations of both assets, and that will simply give you 136,000, which is made up of accumulated depreciation on vehicles, which was what we calculated earlier on, which is 105,000, and accumulated depreciation on equipment is what we just calculated, which is 31,000 rand. You add 105 with 31,000 rand, it'll give you 136,000. In the general ledger, because both vehicles, okay, sorry for that. Because both vehicles and equipment were new, they will not have balance brought down. Instead, we're gonna have bank as an account because we've just bought them for cash, they said via EFT. And your accumulated depreciation on vehicles at the beginning of the year, there was nothing. So at the beginning of the year, accumulated depreciation on vehicles will just be zero. We recognize current year depreciation. Current year depreciation on vehicles is 105, and that will be the balance carried down. And you carry it forward to the following month as 105,000. Accumulated depreciation on equipment goes up on the credit side. So we're going to have depreciation, which is zero. Balance at the beginning of the year is zero. And current year depreciation was 31,000, which will be the balance carried down. And we're going to carry it down to the following month or beginning of the financial year. And that will be the new accumulated depreciation when we start the new financial year. Depreciation is an expense. It goes up on the debit side. It's divided between accumulated depreciation on vehicles, which is 105,000, and accumulated depreciation on equipment. In the accounting equation, both accumulated depreciation will reduce your assets and both depreciations will reduce your owner's equity. Try 10.9 and then watch the next video.